Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Hope you're having a good day. Markets are definitely plunging, and why wouldn't they? All that false anticipation of a Fed pivot, all those false expectations of some miraculous immediate recovery to a nirvana economic scenario for the United States by the middle of the year. None of that is going to happen. So markets have priced in things that just are not going to happen. So it's not just, it's like a surprise to the market that the Fed will be hiking interest rates aggressively for some time yet. It's that the market is already entirely wrong-footed on the exact opposite view. This is what gives markets power. I often say the biggest moves happen when the market is wrong. And on this occasion, the market is being proven wrong again. Ever since the Fed started hiking rates, we've had these people coming out and saying, oh, but inflation will peak at 4%. Oh, it's peaked at 5.4%. The Fed will pivot last year. The Fed will pivot this year. You have to really step back and you have to appreciate that this is an historic event. It's an historic process. It's not an aberration. The aberration was the near zero interest rates and the quantitative easing of recent years. That was the aberration. We're still returning to normal. Therefore, the idea of a pivot it's completely vacuous. Because interest rates are going to stay at these levels and higher levels probably for the next 3, 5, or even 10 years. So once you sort of step back and you see the big picture for what it is, we're merely returning to normal on interest rates, but we have at the same time a tremendous inflation problem, then you know to expect continuing interest rate hikes by both the Federal Reserve and also in Australia, the Reserve Bank of Australia as well. Particularly addressing the US situation, the Federal Reserve has made a mistake of slowing from 50 to 25 points because what this means, as I've said before, is that the whole interest rate tightening cycle has been elongated now. So whereas it could have been over in 2 to 3 or 4 meetings, it's now more likely to be over in 4, 6, or even 8 meetings. If gasoline prices continue to rise, and they will fluctuate in the US, but if they continue to rise overall as global oil prices rise, and I think global oil prices are probably going sideways here for a little bit, but they do have some impetus long-term to the upside. And if that happens, there is no room in the pricing of goods and services in the United States to absorb any increases in energy costs, particularly gasoline costs. So that's why the moment we see gasoline prices going up at the pump in the US, at the Bowser, we know that it's going to impact the inflation prints. It's going to impact both durable goods, as we saw yesterday, which accelerated sharply to 0.7% for the month, which has really finally put the nail in the coffin of that pivot idea. And we saw CPI inflation accelerate also in the last print. So we have headline inflation accelerating on a monthly basis. We have producer prices skyrocketing on a monthly basis. There's this strong pressure from services and shelter and across the US economy to lift wages and lift prices. I think we are already in an upward wages prices spiral. All of this says that at a time when the US economy is weakening, the Federal Reserve is going to continue to be aggressively raising the interest rate level. Usually you have a scenario of a central bank aggressively raising interest rates because an economy is overheating and that's causing inflation. This is an entirely different situation, which is what makes it so particularly dangerous for asset values, both property and stocks. We're going to see a heavy weakening US economy as consumers and businesses continue to struggle under the weight of what are already high prices. And remember, even if inflation was coming down now or continued to come down on the year basis, if it's not negative, it means that the previous price gains, shocks that have come through into the economy are persisting. And that means the stress on consumers and businesses alike remains intense. If we now get another wave of inflation, it's going to make the situation almost unbearable for a lot of American households, particularly those who will experience mortgage stress, as well as ongoing, never-ending inflation and higher interest rates yet again to further increase that mortgage stress or the borrowing stress that they may have. So it's unavoidable that consumers and businesses slow down, retrench on their spending and investment behavior. There's a reason why all the big corporations of the United States, many are laying large numbers, and they are large numbers of staff off. And it's not because they think the US economy is going to turn around in the next 3 to 6 months. They see a long-term sea change happening here, suggesting their glorious happy days are well and truly over, and therefore they need to reduce their staff. Remember, it's difficult to find workers in the United States at the moment because there's 2.6 million fewer of them than before COVID. So it becomes difficult to hire. You would not be laying off such large numbers of staff if you had an expectation of any quick turnaround in the state of the US economy at all. And this was all before the resurgence of inflation yet again. Now, inflation is not going to just continue going up every month forever. It is going to again moderate at times, and it is going to fluctuate. But it's almost now, because price pressures or the profit margins are so squeezed by increasing wages, already established inflation, ever higher interest rates, that any movement in the gasoline price is going to cause higher prices throughout the US economy, not just at the bowser. And when gasoline prices decline, most corporations, businesses are going to see that as with a sigh of relief, as an opportunity to maintain or build a profit margin again. That means gasoline prices falling are going to have a lesser impact on bringing inflation down than when you see gasoline prices move higher. Over the next month, we're likely to see continued upward pressure on gasoline prices in the United States. This means the next inflation print could actually be higher, not lower, than the last print. So that is a lot of risk. And in that environment, where the Fed sees employment as strong, the Federal Reserve is probably going to be hiking interest rates. Well, we already knew they were hiking by 50, but remember, all along I have said to you my target range for the terminal rate of the Fed funds rate is 5.75 to 6.5%. That's always been my target range, even when all those other people were talking about pivots. With risk to 7.5% should inflation be resurgent and stay in the mid to high sixes. It really needs to be below 5%, even below 4.5% for the Fed, to really be on a well-established pause. When this is all over, do not expect the Federal Reserve to cut interest rates at all. It will simply maintain the new level as a new normal to make sure there is no resurgence in the inflation rate. So we could be 18 months, 2 or even 3 years from any interest rate cuts from the Fed. The market has not priced anything as I've just described. This is a major moment where markets are wrong and they're going to have to play catch up to what is right, and what is right are much lower asset values, particularly US stock prices, given that even their company boards see a desperate, panicked need to be laying off staff. Plenty of downside to come. I don't think this is going to be, again, it's not an aberration that the Fed is raising rates to fight inflation. Rates are going back to a new normal. And it's not an aberration that stocks have fallen over the last few days, and because they will be continuing to decline. This is, I believe, a new downtrend for the US stock market. Thanks very much. Enjoy your day. Clifford Bennett, Chief Economist, ACY Securities.